My name is Martin Kessler. I'm the executive director of the Finance for Development Lab, who co-organized this event with the Initiative for Policy Dialogue at Columbia University. I just wanted to say just one word to thank everyone who worked on this event. Gabriela from the IPD, Amanda and Charles from FDL. And the whole team from Read Hall where we are, and I wanted to pass the floor to Elena Maxima from Le Grand Continent, where I also thank for joining us and moderating this session. Yes, I will stop there. Thanks a lot, and looking forward for this event.
Hi. Yes, perfect. Hi, hello. Thank you very much, Martin, and welcome to you all to this exceptional roundtable organized by the Finance Development Lab, the Columbia University Initiative for Policy Dialogue, and in collaboration with Le Grand Continent. So the IMF and World Bank meetings, as you all know, just took place in Marrakesh last week. Sovereign debt was clearly at the center of this autumn's meeting, with growing concerns over incoming sovereign debt crisis in low-income countries and emerging market economies. So uncertainty about their management and about the possible solutions to reform the current processes of sovereign debt crisis management. So this question, I have to add, is also all the more important in a context in which huge investments are now needed worldwide to improve socio-economic conditions for the populations, and in particular to face climate change by financing the energy transition and also adaptation. All this issue will be discussed in the COP28 on November 13, end of November, yeah. So facing all these ongoing issues, the goal of this roundtable is to try and grasp the aftermath of this autumn's meeting about the urgent concern of sovereign debt crisis, and to draw conclusions about the shape that could take a reform of the international financial system to respond to the debt issue. So to debate this great issue, we have the pleasure and honor to welcome a great panel. So first, Joseph Stiglitz, co-president of the Columbia University Initiative for Policy Dialogue and university professor at Columbia. Martin Guzman, also co-president of the Columbia University Initiative for Policy Dialogue and former Minister of the Economy of Argentina. Kemi Adeosun, former Minister of Finance of Nigeria, and Ishac Diwan, who is a research director at the FinDev Lab. So thank you all for being here. And now I want to leave the floor to first Joseph Stiglitz. So what is your takeaway about what should be done about the ongoing and urgent sovereign debt concerns, and your takeaways of Marrakesh meeting last week?
Thank you. To be here. Let me try to describe a little bit the source of the current debt problem and why it's both difficult to resolve or address and important to address, and what some of the things that we might do about it. In a way, the current debt crisis has a lot of analogies to what happened in the 1980s in Latin America, when there was in the 1970s, there was what was called a series of oil crises. Iran, Saudi Arabia raised suddenly their prices of oil, 73, 79. That caused a lot of the world to go into a very sharp problem. In some countries, it led to inflation. The one part of the world that escaped having a disaster at that moment was Latin America. And the reason they did that was they borrowed large amounts of money. And it was often described as recycling the petrodollars, the money that was flowing to the Middle East from the high oil prices. Had to be spent somewhere. And one of the places it went was to Latin America. And Latin America took the money and stabilized itself much better than many other parts of the world. Other parts of the world had inflation and recessions. But the consequence was it led to a big buildup of debt in Latin America. And that was okay as long as monetary conditions didn't change and they could keep getting flows of petrodollars, of dollars. But the high inflation that had been set off in the United States was a problem for the United States. And it got to levels that had not been seen for a very long time, in excess of 10%. And finally, when Paul Volcker became head of the central bank, there was an idea called monetarism. I hope none of you who are students have had to waste your time studying it. It was a very flawed idea, but it had a lot of influence for about a half a century. So it was propagated by University of Chicago. I'm glad you're here. We're here at Columbia. It was really an idea associated with starving the government. It had a lot of bad aspects of it. Pinochet, I mean, we could go on in human rights violations and all that, but the thing I want to focus on here is that it was associated with the idea that inflation was a monetary phenomena, and that you responded to inflation by tightening money and having a simple monetary rule. He didn't trust government, and the rule was you should only increase money supply at the rate of growth of the economy. And so Volcker became head of the central bank, and he trusted this simplistic idea, and he did it. He had no idea what the consequences were, and I can tell you that because I talked to him about it. And the interest rates went up to over 20%. And for Latin America, it was a disaster. It caused what was called the lost decade in Latin America. The high interest rates led one country after another to go into default. Well, I don't want to give you a whole lecture on the Latin American debt crisis, but I want to give the analogy. There have been a set of circumstances in Africa and other parts of the world that had led to an enormous flow of money to Africa for the last decade, actually last 2 decades in some ways. So the first decade of the century was marked by high natural resource prices, and that led to high growth, but it was a decade of 7% growth in Africa. And many of us thought, oh, the problem of slow growth in Africa had been solved. But it was all based on high resource prices. Then that decade was followed by the global financial crisis, But the response to global financial crisis, again, American response, not paying any attention to the rest of the world, was QE, quantitative easing, which was a flow of money from the United States to the rest of the world, and including Africa. So you had this enormous flow of money, and then you had, on top of that, China had an initiative called the Belt and Road Initiative. You can talk about it in many different ways, whether it was a solution to China's internal problems or a new outreach of China in terms of changing the global economic architecture. But the result of it was a flow, enormous flow of money to the developing world, including Africa, for infrastructure projects. And then, of course, the United States had to respond to that, and it too led to a flow of money, not directly from the US government, but underwritten with some US government guarantees. So you had these flows of money, and that led to over-indebtedness. Over-indebtedness on the private sector, it was pushing money, over-indebtedness of governments, and then came the pandemic. Growth slowed suddenly. There was a sudden stop of money, especially after the inflation in the United States. So now we went into a tight monetary policy, and many of the loans of China started looking not so good. Sri Lanka had problem paying, and other countries had problem. So even China had contracted the flow of money. And there had been a phenomena that talked about in Latin America called sudden stops. The flow of money stopped. And that pushed Africa and many other places into crisis. On top of that came high oil prices because of the war in Ukraine, then high food prices, and then many countries quite naturally went into crises. And then there were other crises that were countries that were in somewhat of the gray zone. We call gray zone. They weren't actually, they were able to pay, but barely. And the worry was that they would be pushed over the brink. So the question, the distinction here that we talked about this morning a lot is the distinction between between insolvency, where you're bankrupt, and illiquidity, you couldn't get funds. And the two are very related, but there are some distinctions that, for instance, there could be a multiple equilibria. They could be insolvent if they didn't get any funds, but if there had been funds, they would be solvent. And the question, this is where there's a role for the IMF, there's a role for debt restructuring. The problem is we have no framework for debt restructuring across of sovereigns or across countries. That within every country, there's a bankruptcy law for debt. When people get overly indebted, corporations get overly indebted, but there's no sovereign debt bankruptcy framework. The UN passed a set of principles that would guide this. I chaired a commission appointed by the head of the General Assembly in the aftermath of the 2008 crisis. It laid out a set of principles, and the UN General Assembly overwhelmingly adopted those principles, except 6 countries voted against it, including the United States. So the consequence was all the major creditor countries voted against it, and so there is no framework for debt restructuring as we face a potentially massive problem. That means, in the absence of that, there is what was called a coordination problem. Each of the creditors wants to get repaid, and they don't trust anybody else. And so we have today a very difficult complexity of creditors, not only multilaterals. We have the multilaterals, the World Bank, the IMF, African Development Bank, and so forth. But we also have the private sector. In the 80s, in the crisis there were just a few banks. Now we have hedge funds, securities. We don't even know who the creditors are. And we have China. So, and we have bilateral donors, particular countries, donors and lenders. So it's a very difficult context in which there's a problem of coordination. And absence of that, there is often the problem of too little debt restructuring, and it happens too late. Too late means that there is a debt crisis and that there is a long period of non-growth with a lot of suffering. So that's the situation we're in right now. And it's a big deal because it will mean a very large number of countries people in those countries will have enormous amount of suffering. And it's a big deal that right now we need global cooperation to solve climate change. And these countries won't be able to make the necessary investments in climate if they can't even feed their people. And there won't be any flows of these countries, flows of new funds to these countries without a debt restructuring. And those flow of new funds are going to be necessary for climate change and for restoring growth. And more generally, there's a need for cooperation in all the problems that the world faces together, including the fight in Ukraine and problems in the Middle East. And it's going to be difficult to get that kind of cooperation in the context of a world where we can't get cooperation in dealing with this enormous problem, potential problem of debt and debt overhang. So let me stop there.
Thank you very much for this portrait, which is very comprehensive and will help us understand maybe solutions to the dark perspective you just described. So, Kemi Adeosun, you are a former Minister of Economy of Nigeria, so I think we would love to hear what you have to say about these two phases, like the flow of capital, especially to Africa, and then the phase we are now.
Thank you very much. Well, the flow of funds to Africa was very exciting for most African finance ministers because we had gone from it's the kid that's been starving and is suddenly allowed into the bakery and told to eat as much as they liked, and it was incredibly. It was good. You were being courted, as Prof said. China wanted some. The Eurobond market wanted some, the multilaterals wanted some, and we were suddenly the beautiful bride. And, it's kind of, a little bit of national vanity, but it's kind of nice when everybody wants to lend you money, except for when it's time to pay back and suddenly all the metrics that you had, built your growth plans on have changed. So you go from, and I experienced this, you went from an oil price that was north of 100 that went down to $26. And then suddenly you're not so pretty. And suddenly the suitors are saying completely different things. Just for context, Nigeria currently isn't in any kind, well, I shouldn't say isn't in any kind of debt distress. I think the whole region's in some form of debt distress, either current or loading. And that's just because of the global indices. The Fed are going to continue raising rates. It's every man for himself suddenly. Suddenly we're not so important anymore. It's every man for himself. If the Fed needs to raise rates, they raise rates. Capital flows out of our country. Suddenly we're not attractive anymore. And that switch can be very difficult because a lot of this borrowed money was going into social programs. It was going into, Nigeria started a school feeding program, conditional cash transfer. So a lot of it was social programs, which are very difficult to scale back on. And in a democracy, it's not popular for you to cut programs that feed children at school. So it becomes very difficult to readjust. And I think that's part of why countries that do find themselves in debt distress are very, very reluctant, firstly, to admit it, because nobody wants to be the finance minister to go tell their president that, look, we can't afford to feed the children anymore, because usually you'll get fired. And secondly, in a democracy, these are populist policies. So when you get into an IMF situation where they start to talk about fiscal consolidation, which usually means cuts, cut your spending, that's not popular. So there's a sense of, let's kick the can down the road for as long as we can, which ultimately worsens things. So that's the context I think that a lot of African finance ministers are currently facing. From a personal perspective, and it's great that Prof set took us from the 70s. What I think has been very interesting is that we've had unprecedented levels of capital flowing into Africa from debt, but we haven't seen the growth. That's for me the most challenging, the most challenging part of where we find ourselves. So if you have the debt and you have the growth, you can motor your way out. The problem is that the debt hasn't led to growth. And for me, that's the thing that keeps me awake. Is it the structure of the debt? Is it the amount of the debt? Is it the speed of the debt? Why hasn't debt in Africa led to growth? Because as Prof said, when we did have growth, if you strip it back, Nigeria had 6.7% GDP. It was the oil price. Take out the oil price, and that's why it wasn't inclusive growth. It wasn't affecting people because it was commodity price driven. And as soon as the commodity prices reversed, we started having recessions. So that's just some context from the way I see. I don't have the answers. I'm throwing the questions out. Why is it the quality of the borrowing? Is it what the money went into? But why hasn't the high levels of debt-funded investment in Africa led to growth? That's
Yeah, that's a very deep question. And Martin Guzman, you also are a former Minister of the Economy of Argentina. So what are your perspectives? What do you foresee as necessary in terms of debt management, both domestically and internationally? So.
Good, thank you. And thank you for having me. It's a pleasure to be here this evening. So debt crises are of enormous importance for the lives of the people that go through them. They can mark generations. Joe was referring to the crisis of the 1980s in Latin America after the US Federal Reserve increased the interest rates very significantly in a continent that had debts at floating interest rates. I was born and grew up in Argentina. My first memories are about the hyperinflation, going to the store and stores saying close for lack of prices. Those are truly vivid memories. And well, you see, in my case, it was so important, and then I devoted my life to economics. And they can create different types of extremes. So a country, when it runs out of foreign exchange reserve because it continues paying debt in a context in which it doesn't have access to new financing to roll over those debts, and at the same time, it has a bad situation in the public finances, structural deficits that ends up financing with the central bank. It may up in a situation of very high inflation. But the other extreme that happens particularly when there are fixed exchange rates is that when the country is drained from foreign exchange in the same situation and it loses competitiveness, it's having a trade deficit. It cannot sell to the world enough because it's not competitive. The only mechanism of adjustment for restoring competitiveness is a deflation. Deflation means recession. Prices go down when sellers don't sell, and that's unemployment. So that's the other extreme. Argentina also had it, 2001. It was probably the worst debt crisis in history. So it's extremely important for a society to perform well to resolve a debt crisis when that happens. And today we're going through a wave of a debt crisis in the global south. This is, as Joe explained, it has some similarities with the crisis in the 1980s that most of you didn't experience, was mostly happening in Latin America and Eastern Europe, but also important differences. One important similarity is that by then we had contraction in monetary policies in the advanced economies in response to the OPEC shock. And now we also have contraction in monetary policies in the advanced economies in response to the war in Ukraine. And when in the north you see a tightening of the liquidity, the south suffers. That's a common pattern. The main difference is that we have a different universe of creditors. And while in the 80s, the American financial system was largely exposed, highly exposed to debts. They were, the American banks were holding debt from Latin American countries and Eastern European countries. And a write down, a significant reduction in the value of those debts, or even recognizing that the value was lower than the value that was written in the books, would have led to probably a crisis for the banking system in the US. So the US used very aggressively its foreign policy to avoid that from happening for an entire decade. So that's why many countries in the region, in Latin America, got deprived of foreign exchange, and several of them ended up in hyperinflations. We don't have that situation today. So the market is much more fragmented. And in particular, when it comes with debt with the private sector, it's mostly in the form of bonds, not of bank loans. So the exposure is of a different kind, and it has different political implications. So while that may be better for the robustness of the banking system in the US, it may at the same time be worse for the countries that suffer those debts because people care less in the north, precisely because there are no big systemic consequences. And this crisis has to be resolved in the international financial architecture that Joe described. There isn't an international framework for resolving the insolvencies of sovereign nations. When companies, when corporations are insolvent, they can file for bankruptcy. And there is a system that provides certain predictability. Principles are followed, and that also helps to avoid inefficiencies. So the assets of the company are not depleted, the company can continue operating, and or the assets can be used, and we avoid a destruction of production that otherwise would occur. Well, we don't have that for sovereigns. So that leads to what Joe described as the too little and too late problem. It takes too long to even begin addressing a crisis, and it's absolutely true, the fact that it's not just a problem with the creditors. Creditors want to delay the initiation of a restructuring because they want to gamble for resurrection. Someone else, give me money, IMF, pour some money in this country so we get bailed out. Or let's just wait for a positive shock. But the debtor also prefers to avoid the consequences, the political consequences of initiating a restructuring. These are power processes. There's a lot of lobbying. It's expensive. It's costly for a government to say we're going to restructure the debts. You can imagine all day long the media, newspapers, TV, radio stations. No, this country is going to fall apart completely. It's going to go nowhere. Typically, the big cost happens when the country already lost the market access to credit before, not at the moment of a default. But that's how those processes work. So where are we now? We're in the context of this crisis, and resolving the crisis requires two levels of dispute resolution. One is between the debtor and the creditors as a whole. So how much debt we write down, okay? The second one is among creditors. How do we distribute the write down among the different creditors. Both levels of conflict are pervasive, difficult to resolve. Again, political processes. For low-income countries today, there is a forum of coordination. It's the IMF Global Sovereign Debt Roundtable. I think there is more optimism about how it's actually working than what it's actually delivering. And for middle-income countries, there's nothing. There's just power disputes. So we're looking forward, what we will probably see is some restructurings get done. They're happening already, but they will continue falling into the too little category. Most of the restructurings are happening, in my view, will have to be followed by another restructuring soon. And at the same time, we have an additional destabilizing factor for countries in debt distress, particularly the emerging markets in debt distress that have debt with the IMF, which is the IMF lending policies. The IMF is supposed to be the lender of last resort in the global economy. The institution was created after World War II, 1945. It's supposed to play a counter-cyclical role, but it turns out that the cost of financing of the IMF is also a floating rate. Like Latin America in the 80s that had debts with floating rate, and when the Fed was increasing the rate, the continent was suffering. Well, the same happens today for all the countries that borrow under the so-called upper credit tranches of the IMF. So not the poor countries, but the others. The interest rate of the IMF depends on the interest rate of the US bonds, UK, Japan, China, and the euro area, the 5 reserve currency economies. And because of the contraction in monetary policies in those countries, the IMF interest rate increases very significantly. The basic rate today is 5%, but many countries pay an extra rate, it's called surcharges. So they have to borrow at 8%. You see, this is a lot of money. So it could be more than the entire budget in education or health of a country, the cost of a country of serving that with the IMF. So that makes their life more miserable as well. And looking forward, we have to look precisely at these two variables that you described earlier. So debt grows at the interest rate. So your cost of refinancing the debt determines the pace at which debt grows. And if the economy grows, it creates more resources, more tax revenues, so the debt is easier to pay the debt. The debt to GDP ratio falls. So debt grows at a rate that depends on the difference between R, the average interest rate that the country pays, and G, the growth rate of output. Where is the world going? Likely in a world of higher interest rates for some time. So that's gonna make debt sustainability, that's gonna create more debt sustainability problems. And G will depend on a number of factors that are so difficult to anticipate. But even if there is an increase in the growth rate of output in the global economy, the way that that growth is distributed will matter for the sustainability of debt in emerging economies. All the progress with artificial intelligence, the increase in productivity that they can bring, will likely be distributed not in equitable ways. Same with the positive growth effects that the transformation for dealing with climate change could bring. Some countries have better technologies and more access to financing than others to run those policies better. So R minus G will determine that sustainability, but that G is particularly the G that applies to countries that are in situations of being exposed to that distress. Bad news for some, good news for some of you, like Charles, I see you there, that you have the skills and you work for this, but for the students, certainly this is an area that should be of massive interest. Thank you.
Thank you. Thank you very much, Ishac Diwan. You have a great experience in the field and in research. And to what extent do you agree with this diagnostic, especially the strong statement that there is no structure for sovereign debt restructuring management? So from the actual system, do you think like reform is necessary, or even more like a revolution or rebuild everything? So about the solutions, to what extent do you think the problem is deep and should be reformed?
Elena, this is a great question. Maybe to make it exciting, I should say I disagree with some of what Martin said, not everything, of course. let me first say that's really great to see so many students. And the Finance for Development Lab, perhaps we should do more of these, organize more of these meetings. So it's great that the room is full. Now, maybe just I should start by saying that developing countries are extremely angry. You know, you've seen it at the Paris Forum. We saw it with the president's meeting in New York right now. I mean, there is this 20 years of growth that you all spoke about with access to Chinese funds, private sector. So, you know, countries are moving from poor to middle income countries, borrowing from the market. Commodity prices are rising. It's a constellation of forces. We have 20 years of high growth. On average, Joe, you said 5.5%, 5%. And then suddenly, 2019, COVID happens, no vaccines for Africa and for poor countries. Then the war in Ukraine, food, fuel prices shoot up. They can't afford to pay for them. Then interest rate rise because of the fight against inflation in the US. The bond market closed. Suddenly they have to be repaying maturities. They can't refinance. The world has changed in 3-4 years from boom to bust. And so really when we talk about solution, we have to be aware of the anger of, you know, life is cheaper in the south than in the north. We don't even get vaccines. Everybody's talking about climate change and moving to trillion and all of that, and we're stuck in a crisis. We can't even feed our population. So enormous amount of anger and a feeling that the world has let them down, basically, that development has fallen to the bottom of the agenda. So that's the situation. Now, how does the world respond to this anger? One way is to say, well, eliminate all the debts. And there's lots of that, a lot of civil society groups, like in the 2000s, debt is immoral, debt is a burden. I'll exaggerate if I say this is the case you're making, but to some extent, right? No. Well, all right, then I don't disagree with you, but it would have been fun to disagree. But what's important to realize is that, you know, after this big boom, the countries are in very diverse situations. Some have used this money well, some have misused it in corruption, in clientelism, in consumption. Others have invested in infrastructure, and still they were all in a shock, but they're not all in the same condition. Some definitely need debt reduction, but to push them all to have debt reduction is short-sighted, especially that they've invested so much in having access to the market. The late Daniel Cohen is not with us, otherwise he'll be sitting here. And really, it's a moment to also pay him homage. He's the founder with some close friends of our group. The last article we wrote together was called "The Fork in the Road of Development." And the fork is about that choice. The choice of dropping the market and having all the developing countries back in the hands of the public institutions only, versus the other road, which is to figure out a way to pass this bad moment so that actually countries remain open to the world, especially that they've invested, that they've moved to lower middle income countries, they want to move up, and to address the green challenge, the climate challenge. You need a lot of private funds. The public alone is not going to be able to do it. So instead of destroying the market and having to wait 10 more years, we need to be much more refined in our solutions. Some countries definitely need debt reduction, but not all. Others have liquidity problems because of the complexity of the creditors group. China, the US, don't trust each other. The market being afraid of that, stopping, you know, sudden stop. And so how to provide liquidity in order to pass this difficult moment with high interest rate that can last 2, 3, 4 years, and then, you know, land back in a good place is the challenge for many countries. Now, the international community has focused a lot more on the difficult cases of debt reduction than on the many, many more countries that need liquidity relief. liquidity that is more than what the IMF alone can provide. And therefore that would require reschedulings of existing debts. So how to get the private sector and the Chinese to reschedule while at the same time the multilateral development banks are putting money on the table to allow the beginning of a green transition. I think that's the difficult moment we're in. And what I saw in Marrakesh and in today's discussion among specialists is the beginning of a thinking about how can the world get organized to come up with this kind of initiative that we can call a bridging initiative, how to pass from here to the new world where we can focus on investment in climate adaptation, without getting stuck in a very long adjustment period.
Thank you. Thank you very much for this first roundtable. And I want to turn to you, Joseph Stiglitz, again. So what do you think about what's just been said? Like, do you think, you talked about geopolitical fragmentation. What do you think about this possible perspective of reorganizing more comprehensively and taking stock of all the country situation, not only the countries in crisis? Like, do you foresee and what do you feel like was said in Marrakesh? Do you see this impetus growing, or do you think it's going to be still difficult?
Yeah, well, let me begin by saying, if you think about the scale of the level of funds that are needed, particularly when we talk about the green transition, not just the temporary, hopefully temporary interruption of the flow of funds, it's beyond the amount that the world's current financial market is organized to provide. At Marrakesh, people talked about, trillions of dollars. And when there was a lot of excitement about finally the World Bank has a president of the World Bank who recognizes that there might be climate change, as opposed to a climate change denier that had been nominated by Trump. So it's good news that the World Bank is involved, and the big discussion at Marrakesh was about increasing the leverage that the World Bank could take and a little bit of more recapitalization of the World Bank so it could lend more. But even with those moves, it would be a small fraction of what is needed. And most of the discussion that I was involved in talked about the need, is the same discussion I've heard over and over again. We have to get the private sector involved. To get the private sector involved requires de-risking their appetite for lending in Africa. The risk premium they demand was too high, and we have to have ways of lowering the risk as it's perceived by the market. It's the same conversation I've been hearing for more than a decade, and I guess my own sentiment is more on the side of we've had problems with the private financials markets for a very long time. People don't remember here, but we had a major global financial crisis in 2008 because the financial markets undertook too much risk. In the aftermath of that discussion, everybody talked about financial markets don't assess risk well, they're short-sighted, and climate change is a long-run problem. Climate investments are risky, and climate is a global public good, and the private sector isn't in the business of providing public goods. So my reaction in general is why we would expect a dysfunctional private financial market, which is short-sighted, doesn't know how to assess risk well, and to do a good job in financing a global public good like climate change. And then I think about, why is there so much liquidity in the private sector? Why do they have so much money? Well, because we have public central banks pushing out money until they decide not to do it. And so they've given the private sector all this money. We have this very circuitous system of central banks lend money to private banks who lend money to hedge funds and other private lenders who then lend money to the developing countries to make these investments. Why not short circuit that approach and have money go directly to multilateral development banks? Well, there's one good reason is the multilateral development banks have problems. They're not perfect, but as I've just explained, I don't think the private sector is perfect either, and that roundabout system is high transaction cost. So I put a little bit less hope in the private sector than Ishac does, and I would like to push a little bit more expansion of the multilateral development bank system. Much more.
So thank you, Kemi Adeosun. About from the perspective of Africa, especially, I'm thinking about there is a COP28 coming. There was a summit for climate in Africa a few weeks ago. So how would you describe the countries foresee this diversity of creditors, diversity of solutions? We saw public and private sector. How is the organization going, and how do you see it from your perspective?
I think, as Prof said, climate is a global public good. And I think COVID, interestingly, taught us that health is also a global public good. And for COVID, we kind of ripped up the rules, right? So we ripped up all the debt ceilings, we did what we had to do. I'm hoping for a similar approach to climate. I think it's getting to that stage where we've got to see it in that context. And there is an opportunity, I think, which Prof alluded to earlier on, with all this excess liquidity that's looking for yield in the global north. And then you have the global south that has some of the solutions to some of the climate challenges. There are some interesting swaps bilateral going on. The Qataris are doing some interesting things where they fund some projects and they buy the carbon credits to offset some of the things they're doing. So there's some interesting bilateral sort of, I would call them proofs of concept. I don't think they're fully developed yet. I think it's the right kind of thinking. And I think that, and here I disagree with Prof. And he wrote all the textbooks, so I don't like to disagree with him. But I don't like multilateral lenders as a finance, as a creditor. I really don't like them. They come in and they give you, they come with a checklist. Whereas the private sector just gives you the money that you need, right? And they come with a checklist like, we've got to have something on gender. We've got to have something on the disabilities. And these are all good things, right? But maybe they're not my priority. Maybe my priority is just getting power or getting food, So I think that the multilateral, and also the multilateral lenders tend not to be very, very fast. So that's the other challenge I think I have with them, quite bureaucratic. So I'm not sure that they're the solution either. I think it's going to be somewhere in the middle where we begin to use maybe the multilaterals wrapping some new instruments. So you issue a green instrument with a World Bank wrap and letting the multilaterals use their balance sheet to de-risk some of the transactions for the private sector. I'd be more interested in seeing those sorts of innovations. I think that would be very interesting for Africa. And back to my question around growth, I think that's also the solution, to tie some of this money to projects. There's a lot of skepticism about the Chinese and lending. And I negotiated quite a few Chinese loans. I like Chinese lending because it's project tied. You may say they ask for this, but you can see where the money goes. And this is down to my issue about delivering growth. You need the structures to actually deliver the growth. Otherwise, the capital leaks away. So I actually like the structure of the Chinese. There's some aspects of it I don't like you have to use their contractor and all that. But those are negotiation points that can be got around. But I think there's something in the middle that could be the solution. Thank you.
Yeah, so Martin, Guzman, I would like to go back on this question of new instruments with you, and you talked about the length problem of the process, and maybe Argentina is an example for that. So which new instruments and which new processes do you foresee? Because there is the diagnostic, but do you see some innovations that can be possible?
Good. So let me more generally speak about the issue of financing for development that is being discussed in the different interventions. So financing for development must be stable. Otherwise, it's not financing for development. It's financing for future crises. And the kind of financing that can be stable, it's either financing in the local currency with a stable base of investors, or the financing from the public institutions, and I would definitely include the multilateral public institutions. The issue is that the multilateralism has different segments, and some may serve better the interests of a country than others. In the world we live today, financing from regional multilateral institutions is more important, that have also more proximity to the country that gets the financing, and more representation of the country that gets financing. So ultimately, this requires the development both of domestic capital markets and of regional financial institutions. I think including regional institutions that could play the lender of last resort within the region. I don't think countries should depend on the IMF, given the way the IMF works. The kind of financing that has definitely not been stable in the world is foreign financing from the private sector. I mean, in foreign currency, foreign law. Your example of the sudden stops. Financing comes and all of a sudden it just stops and the flows are reversed, and that creates crisis. That creates not just currency crisis, but it can also create banking crisis. They cascade into the system, and those of you who are students of economics or economists have learned about the concept of complete markets and associated complete contracts. When you can write contracts such that every possible contingency is included in the contract. You index the payoffs, the payments to each possible contingency. And those contracts are never broken by definition. They can always be fulfilled. Those are not the kind of contracts we have in sovereign debt. We have incomplete contracts, and countries pay for that. They pay a risk premium. And if we had a good system that says, all right, under certain circumstances, there needs to be a restructuring, that's what justifies the risk premium, and it can be, that problem can be resolved efficiently, then I would be more in favor of, I would have more appetite for that kind of financing, but that's not the world we live in. So given the way the international financial architecture works, I'm more inclined to recommend countries to focus more on developing the domestic capital markets and pushing for the enhancement of regional multilateral development banks.
Thank you. What do you think about this focus on regional multilateral lenders, not only the IMF and the World Bank?
I mean, Africa, I think, is the only country without a regional type of IMF. So it definitely needs a facility where it can swap and stabilize its debt. If I can react, again, I don't agree, if I may. We're not in the 90s anymore. I mean, Africa had a debt crisis in the 90s. It took a while to solve till the 2000 and the HIPC debt reduction, the highly indebted poor country debt reduction. Then the debts were owed all to the multilateral institution and to bilateral governments. There was no private debt to speak of, very, very little. And that was, resolved with a massive debt reduction. Today, we're not in the 90s anymore. If you look at the composition of African debts, first of all, the external debt ratio on average is not that high. It's around 30%, 35% of GDP. In HIPC, it was close to 60% of GDP. Second, and it goes with what you're saying, a good part is domestic debt. In addition to this 30% of GDP in external debt, there is domestic debt, which is very good. So domestic debt markets were developed, saving rates have increased, Africa is much more relying on its own saving, on its own private sector. All this is progress. Now, if I look at the external debt, 40% is multilateral institutions. 40% is private sector. This is major. It's as much as the multilaterals, and it's totally unlike the 90s. And 20% is Chinese. So, China doesn't own Africa. It's a diverse coalition. It's a more complicated problem, but it's a more complicated continent. It has evolved. We're not in the 90s anymore. And so it's going to take, it's more complex to resolve this problem. But as we're all agreeing on, it must be resolved forcefully in order to not be stuck with a continent that's not growing, that will not allow the world to save the planet, but it must be solved in a way that helps Africa become an actor in alliance with others in saving the planet. So we must quickly transition to a phase where the whole world is putting efforts into a green transition.
Thank you very much for this great overview. Maybe the public now has some questions to ask. So here.
Thank you. My name is Florian Armand. I work at the OECD, but my question is just on behalf of myself. Where are free markets? That's my question. Where are free markets when we have climate change and that indeed markets cannot take the risk and responsibility? They are not. There is not the right structure. Where are free markets when there is the IRA in the US and the rule of law of the WTO is abolished for steel, aluminium, automobile? Where are free markets when the EU, the US, China, Japan, every single country on this planet is helping tremendously the private sector in R&D, in taking risks? So where are free markets? Do we still need them in this time of change? That's my question.
Yeah, maybe we can take two more questions for this first one.
Hello, I'm David Whitehouse, a journalist with the Africa Report. I'd be interested to hear if the panel have any thoughts on specifically why African debt restructurings such as Zambia and Ghana are taking so long, particularly the Zambian case, and are there concrete steps that could be taken to get them over the line quicker, along with possible future debt restructurings in Africa?
Okay. Hello, my name is Jad Shaban. I'm a professor of economics in INSEAD. My question to all of you, and more specifically Professor Stiglitz, is you mentioned a couple of weeks ago that you're in favor of issuing more SDRs to finance climate change, maybe 300 billion more SDRs. Given that the IMF has issued already 650 billion US dollars in SDRs, in special drawing rights basically, and that half of the world debt is in US dollars, aren't we reinforcing more propagation through US dollar by not basically reforming the whole IMF and getting more votes for China maybe on the IMF board, and then lending in multilateral currencies? And this applies also to the countries represented here. What do you think about this phobia and this fixation on always borrowing in US dollar? Thank you.
So for his first round of question, maybe you want to start about free markets, two cases of restructuring and the SDR.
Yeah, let me try to respond to the first and the third question quickly. On the first question, where are free markets? There is never such a thing as free markets. All markets exist in a context where you have regulations and government intervention of one form or another. Markets don't exist in a vacuum. But what you've emphasized is that in many of the areas that we're talking about today, climate change, externalities are first order, and therefore there has to be regulations, government investments, and intervention if we want to get anywhere livable, if we want to save the planet. Now, unfortunately, those interventions are never not done optimally, but it's better to second best to have them done than to let the world fry. So in my view, the IRA was not very well designed, but at least we got the US to start doing something about climate change. And it's on, for those who may not have followed, it's on a massive scale, unintentionally. What was supposed to be a $270 billion tax credit, and that's a lot of money, has wound up to being over $1 trillion, between $1 and $1.5 trillion. Obviously, that distorts the market enormously globally. Europe response is partly to try to match US subsidies, but finds it difficult. But developing countries have no way of matching it. So the whole framework of the WTO of trying to create a level playing field has been totally destroyed. And so we're in a very difficult place in that respect. But as I said, it's clear that markets often don't function very well, and that's not only in climate change, but also in moving money to developing countries. And that's why we, again, should have, I think, strong government intervention. Now, one way, as Martin pointed out, the big issue here is development finance. How do we get money to finance development and the environment? And the reason why I've been a strong, for those, special drawing rights are the mechanism, are just like governments print money. The IMF, being sort of a bank of the globe, can print money, and it has certain rules. I would prefer they change the rules, but currently they print money and they have to distribute it according to the quotas, which are the ownership shares of the different countries. Now, it's a peculiar kind of thing because, like in the pandemic, they printed $600 billion worth of these special drawing rights. Those are denominated not in US dollars. They are a bundle of currencies that include the euro, the RMB, which is China's currency, and the yen. So they're not dependent on US dollars. They put the money in the accounts of countries, and the rich countries like the United States and Europe typically just sit on the money. It doesn't do anything. It doesn't cost anybody anything. It doesn't benefit any money. It's sort of an entry on a book, on a bookkeeping account that nobody has to pay any attention to. But for the developing countries and especially highly indebted countries, it makes a very big difference. Now, there's been a big global movement to try to persuade the countries that don't need the SDRs to recycle that money, to lend or give the money to the developing countries. And so it's this peculiar kind of money that can be used to actually buy goods and services and most importantly, repay debts. And so the idea that, ideally what one would want is this annual emission of SDRs, which would then be recycled to other countries on the condition that they make incremental investments in emission reduction. And so it is, if right now we have this enormous need for developing countries to engage in emission reductions, no matter what Europe and America does, if the developing countries and emerging markets don't reduce emissions, we're not even going to get anywhere near the 2-degree target. So we have to provide finance. And so far, neither Europe nor America has been very good at providing the finance. And the developing countries and emerging markets attitude is, even though they are now the largest emitters, particularly China, their view was the problem was created by the advanced countries. They should help the developing countries and emerging markets solve this by giving them money rather than asking them to pay for it out of money that would otherwise go for health, education, food, or development.
I'll take the question about Africa debt restructuring. I mean, I think those two cases you mentioned, they have their own peculiarities, as I'm sure you're aware. Why is it taking so long to get these restructurings over the line? I think it starts in the run-up period, and I spend a lot of time thinking about this. A country doesn't suddenly default on its debt. There are some early warning signs that happen sort of in the months, in maybe up to 15 months before a default happens. And I think it's the failure to manage that pre-period that creates the problem in the restructuring process. There are holdouts, there's lack of transparency, there's sometimes lack of visibility as to who all the creditors are. I believe that in Zambia's case, I think it was the exposure to China that the other creditors wanted to see, and that lack of transparency can cause a problem. So I think what I'd like personally to see is that run-up period managed better. Even if you don't need it, having eyes, I mean, there are certain countries already that are being identified and already talked about as on the verge of a debt crisis. And I think the problem is we all sit on our hands, and there isn't a role. The IMF have to be invited, and usually by that time things have gone pretty bad. So what can the creditors do? What can the Eurobond holders do to get together to begin to initiate these conversations in the run-up? And that will help to design a far better restructuring program and get it over the line quicker. And if it's not needed, then, as we say in Africa, nothing's spoiled. You've only wasted a bit of time, but if it is needed, you've got a head start on the problem. So that's my take. Thank you.
I'll reply to the second part of the third question about these cycles of borrowing in foreign currency. To an important extent, they are determined by global liquidity. when global liquidity increases, liquidity flows to countries that where the yields are higher. That's what actually happened in 2008 in a world of zero interest rates in advanced economies, and abundant liquidity after the bailout of the US government to its financial system following the fall of Lehman Brothers. Much of that liquidity became global. So most of the countries we are discussing today borrow in international credit markets, but they didn't do it at rates that reflected the cost of financing in advanced economies. They borrow at higher rates. For instance, Argentina in 2016 reaccessed international credit markets after 15 years, and it borrowed at 7% interest rates in US dollars in a world of zero interest rates. In only 2 years, it lost access to international credit markets, and the debt was, first it was paid, part was paid with a loan from the IMF, the historic record loan, $45 billion. By that time, what we were hearing is that, no, this is a problem of liquidity. So we need, creditors would say, and the government by then was defending the position that we need financing from the IMF to meet a liquidity crisis. And then that's going to restore confidence. And what happened was exactly the opposite. The increase in exposure to the IMF and increasing the debt levels, it led to higher risk premium, lower risk premium, and the country ended up having more debt and a worse economic situation. Foreign currency debt is unstable. That's the evidence, at least in the region. And on the domestic debt markets front, what we've seen also over the last 15 years is a significant increase in the financing in domestic currency, but also including of external financing in domestic debt, in domestic currency. So external investment funds and hedge funds that are also unstable source of financing in a context in which there is a free capital account. That's an issue in Latin America. I'll tell you an anecdote. We've been working with a co-author for years who was writing about the importance of capital account regulations and capital controls. And then he became the finance minister of a country in the region. And we all expected that country to adopt capital account regulations. And he was sending exactly the opposite message. We're never going to do it. And then and why? We were wondering why. And the reason was that 30% of the debt was denominated in foreign currency, and just the perception that there could be adoption of capital account regulations could lead to a capital flight and depreciate the local currency. So it's important to develop those markets, but the way they get developed matters for the rest.
I don't know what to add. Maybe a political economy. We haven't talked about that, and that's important also. You know, I can give you two cases like Argentina where the IMF loans ended up terrible for a country. One is Egypt and one is Tunisia. 2016, Egypt had a crisis, not enough for an exchange. It went to the IMF. It has an IMF program. It devalued by 50%. It did all the belt tightening that the IMF asked for. And as a result, it managed between 2016 and 2020 or 21 to borrow $100 billion from the market. It didn't do any real reforms. It just invested them in new cities and in military companies. And in the meanwhile, the private sector literally disappeared. Private investment to GDP is now less than 5%. So the IMF program put a stamp of approval, allowed Egypt to delay reforms as opposed to make reforms. And at the end of the day, we have a much bigger problem today in Egypt than before. So that's, a very bad case. Now, I would frankly fault the Egyptian government here. Other governments can use foreign money well. I don't think it's always bad. I think it's very important for countries to sort out their own problem. They can get into bigger problem or they can get into solving problems. And we need to look at the politics. Now, we can fault the IMF for not looking at these things, for putting the stamp of approval on wrong countries. And we can ask why, in some cases, they are pushed, lobbied by foreign governments that are powerful, that misuse the IMF, and, all kinds of suggestions, and we talked about it today, to reform the IMF itself so that it can serve its purposes of firefighter better is important. Some of these reforms we've talked about today is the place of China, for example. Does China have a bigger place in voting rights in the IMF? Will the world converge to good global governance, or is it diverging to two systems, two competing systems? And what would the divergent word, what would it look like? Now, clearly, part of the answer on why Zambia took so long and still is not resolved 3 years on is this kind of disagreement, basically, between China and the United States, or China and the West. And also some of the issues we discussed, Joe, today, you raised that issue. Is it really a disagreement? Is this a lack of coordination? Or is it kind of learning how to work together with, the two types of institution having different rules, working at different speeds, and learning on the back of Zambia how to start cooperating on this kind of new problems?
I think we can take two last questions approximately. There was Sir in the front, I know.
If I may ask two questions quickly. The first one is to Joe, because I really liked very much, and I agree very much with the way you showed the parallel between the debt crisis in the 1980s and the debt crisis now. But it raises the question in my mind is, why haven't we learned from the 1980s? And are we going to be repeating the same issues, the same problems 10 years from now? How could we stop that? My second question is also is to all of you, which is, we heard that the private markets cannot deal with the global public goods. We also heard that the multilaterals are not very good. Isn't it time now to think of a completely new, and the reason the multilaterals are not doing a good job, I used to be vice president of the World Bank, by the way. So the reason why the multilaterals are not doing such a good job is the governance structure of those and the lack of voice for the global South. Isn't it time now to think of a way of bringing about some kind of reforms and maybe a new type of multilateral institution that gives voice to the global South, but also voice to civil society, to the private sector? The world today is very different from 1945 Bretton Woods.
There's a question online. There's a few questions online. We won't have time for all, but there's one that goes well with the first question of Hafez, which by Estela Nimbeya, which is if it sounds like a lot of the trends of debt are very predictable. So why can't we deal with them earlier before the problems arrive if we can predict them?
So yeah, if you want to start.
Let me start. And in some ways, the predictability is related to your first question, why haven't we learned? You might say, at least part of the answer is there are incentives not to learn from what's happened and not to respond to what is predictable. What do I mean by that? Let me give you an example. One of the, in another context where I think it's even clearer, I mentioned before we had this big financial crisis in 2008. We had in the United States the S&L loan crisis in 1990, the late 80s, early 90s. Part of those financial crises were we learned from that underregulated banks take excessive risk, and they have incentives to do that unless they have incentives to take risks that lead to bailouts, and that's why we have to regulate them and supervise them. Well, we passed a law in the United States, 2010, called Dodd-Frank to regulate them. Not a perfect law, but at least moving in the right direction. But then we had an election. President Trump got elected. The Republican Party doesn't believe in regulations. Why does that? It's political economy. Finance comes from the bankers, and the bankers didn't want to be regulated. And so they appointed Jay Powell to be chairman of the Federal Reserve. What does he believe in? Not regulating. So he spends a number of years deregulating. You have stress tests that test the viability of the banks. One of the most important issues in regulating banks is capital adequacy. And you know that the price of long-term government bonds goes down when you raise interest rates. But when they did stress tests, they forgot this. Now, was that an accident? I mean, you know, anybody who'd taken a course in economics in the last 25 years knew this. And here he was, the chairman of the Federal Reserve. They have stress tests that did not look at that. It was supervised, and so what had happened? They raised the interest rate, and we have the collapse of Silicon Valley Bank, the third largest failure in American history, costing about $30 billion or more. Have we not learned? Yes, we learned. We teach all our students about it, but they hadn't learned at the top. And then we have a supervisor. The supervisor is the San Francisco Federal Reserve. Who sits on the board of the San Francisco Federal Reserve? The president of the Silicon Valley Bank. Well, is it a surprise? Well, you can say, well, it's not, you know, he had nothing to do with it. I think that's right, but it creates an atmosphere in which you don't happen. So to go back to your question, which I think is a very, very important one, and Martin will probably elaborate on this, the underlying problem is not that we haven't learned the lessons, but it's the power structures that make the decisions. Now, that leads in part to the second part of your question. We need to have different institutions, and that relates to the regional banks, not the regional banks that are global in the governance, but the regional banks in Latin America. There's something called CAFE. I don't know. Yeah, CAF. What is it? Yeah, which is owned by the countries in the region, and as a result is much more responsive and to the governing structure. I think at the same time, I think it is important to have these kinds of global conversations, and some of this was going on, and not in the at the center of the meetings in Marrakesh, but in the sidelines, and that hopefully filters into the, you know, hopefully we have a democratic, but even in non-democratic countries, ideas filter in, and an increased awareness of these defects in governance are important. Now, part of the problem, though, and I guess, is that whenever we start thinking about public money, and this is, we start worrying about our beliefs about how public money ought to be used. And that leads to all those constraints on how we use it, gender and all those other constraints that then make it slower. So that's part of the tension that we constantly have to face and debate and put pressure. So one of the other things going on in the discussions in World Bank reform, multilateral development reform, loans from the World Bank have take up to 3 years, average is over 2 years. Governments only last for 2 to 3 years. Very hard for governments to plan when they can't count on having a loan within their lifetime. So that's part of, again, of the reform, is to try to somehow make sure the loans are done in the right way. And then the final remark, let me say, part of the thing about conditionality is not only making sure the loans are consistent with our principles, but the money is used well. The idea, the big mistake in the case of the IMF loan to Argentina was they didn't put the right conditionality. They should have said, you can't use this money to finance the bad loans that were made 2 years ago and have the money go into Argentina and out the next day. And the US government said, no, we don't want that kind of conditionality. They're always in favor of conditionality. And then you have to ask, why didn't they want that conditionality? Well, you become suspicious. It may have to do with Wall Street wanting to get money out at the public expense. It's hard to find the fingerprints, but the circumstantial evidence makes you at least raise that question. And so, I have a very ambivalent relationship with conditionality, but in the case of Argentina, I have the feeling that they should have put that condition, and I've also said that in other cases too.
Thank you, Prof. I think your comments just expose how political the multilateral lenders are, and how this long period of loan process, the whole governance structure, it's very slow, it's very cumbersome, and it's very much controlled by the staff. I mean, I'm speaking from experience. When you go to the governor's meeting, they literally have given you what you need to read line by line. Even as a minister, they say, madam, you're the governor, but this is what you need to read. And I change a word and I come out and they're like, you shouldn't have changed that word. So it's a very bureaucratic organization. You've also got people's careers. This is what they do for a living. Are they meeting the needs of the regions, creating that growth? I don't think so. I mean, think about the AFDB. AFDB now, the non-regional are bigger than the regional. So it's now controlled by America, France, Germany, and so on and so forth. It's the African Development Bank, but you may as well remove the word African and just bung it alongside the World Bank and the IMF. So there is a need, and so that nexus, that closeness, that understanding of local markets is gone. It's completely gone. And I'll give you an example of a loan, and I think she's gone now, from South Africa, but South Africa was trying to do a coal-fired plant. Germany blocked it. It's not green. We will not vote for anything that is not green. But you fire, 60% of your electricity comes from coal. Yes, but it's not green. Go do solar. But we don't have enough sun. Think about solar. So it's, and it's the same people on the same director representing on the IMF board, on the World Bank board, and on the ADB. So we as Africans sometimes feel like this feels like a conspiracy. We're hemmed in everywhere. So we do need new regional lenders, but we also, I think, back, and this is my last comment, but back to Prof's point, we've got to see growth as a global public good. Growth in Africa, growth in the emerging markets must be a global public good, because the instability that is caused when it doesn't happen then You know, the overspills affect everybody. I mean, that sounds a bit like an ominous threat, like if you don't help us, you will pay for it. But that is the economic reality I think that we're moving into, right? My last comment.
Pick up on one point you made, which is the hypocrisy when and I don't know whether you want to react to it, but you know, as an American watching the dysfunction of our government, to have the U.S. government tell other countries about good governance seems, you know, what is your reaction?
Well, actually, I did in 2016, I think, at an IMF meeting, actually use the word hypocrisy, and it got well reported, and I got told off. But anyway, yeah, it's rich sometimes, right? So, you know, I believe the polluter should pay. I mean, this discussion we're having about green finance, if you take, who are the polluters? Whose problem are we solving? How do we transfer those funds to the people who can possibly solve it? Not at Eurobond rates, but at concessional rates that ensure that the polluter pays. That you know, you're talking about climate finance, that's the solution, that's the model we need. And it's very easy for us to, I mean, we've got a lot of sun, but solar is very, very expensive. Coal is still cheaper. You know, if you don't want me to burn coal, how about you pay for it? Or how about you subsidize me a little? You know, and then we can begin to have a sensible discussion that begins to solve the problem. I've said too much.
All right, so a few reactions to the online question, which is a very good question on how come these crises happen systematically? How come we don't learn about these processes? A benevolent view would be that there is real over-optimism at times. You know, every time there is a problem of borrowing, there is a problem of lending. It takes two to tango. And we've seen situations throughout the recent history of massive disappointments. The one example is countries that follow the Washington Consensus policies and adopted reforms that were supposed to significant increases in productivity and therefore in social welfare if they were properly distributed. And that didn't happen. Argentina is always invited to the crisis club, fall into that category. In 1997, Argentina was a poster child of the Washington Consensus in the 1990s. In 1997, the president was invited to the IMF to be the keynote speaker, showing Argentina as the example to the world. And the year after, a recession started, and it ended up being the worst economic and social crisis in history. 23% unemployment rate, 57% poverty rate for a country that is not a poor economy, not a low-income economy. So over-optimism may happen on both sides. Second, there is an alignment of incentives. The creditor side may want to search for yields, but the debtor is happy when there are inflows. Inflows win elections, and outflows make you lose the elections. Okay, but that's a nice part of the story. Even if it's at 10% interest rates, right? Then you will pay, but when you get the money, you win. And somebody else will. Eventually, the people suffer. And I don't know if you've ever seen how this process of bond issuances work. Some of you clearly have seen that, have been part of that, but I would add it's minor relative to the others, but these things, small things matter. There is even cognitive capture. You go to a very nice building in Wall Street, with a very nice view. There's a nice road show. You eat nice food, good food. So then those that are actually involved in that feel sort of powerful and excited about it, and it adds to all this madness that we end up having, particularly in the global South. There are things that can be done to deal with this. And one thing that I did when I was the economy minister of Argentina was to submit a bill to Congress. It's called the Law for Strengthening Public Debt Sustainability, that makes the in order for the government to get financing in foreign currency and foreign law, or financing from the IMF, it needs the approval of Congress. So that's going to make more difficult to enter into these cycles of borrowing in foreign currency. But ultimately, there are factors that I think will probably ever be present, right? And the actions of governments do matter, and they can make a difference.
You know, I want to take just a minute or two in defense of multilateral development banks, World Bank, safeguards, and all the difficulties they cause. And it's because of that that it's good to have a mix of public and private. You know, the World Bank is cheaper. The International Development Association is even cheaper. But this comes from taxpayer money in the West. So, of course, they have the right to say, I care about some things, right? So it does come with some string attached. You know, when I was in the field, say in Ethiopia, you know, to finance a dam, you know, Ethiopia wanted the World Bank to finance a dam. The World Bank says, fine. However, you know, we want to make sure you don't displace any population without compensating them. You know, we want to make sure you take care of all historical and cultural artifacts. We need to make a study to make sure this is all done right, that you're not destroying the environment. You know, a lobby group from Berkeley came and said, you know, the white frog that exists in this valley is unique and you risk destroying it. So it took years. And, you know, by then China came and financed the dam, and the government told us, we don't want the World Bank to finance dams. You know, you finance social safety net and health education because you know, your conditions there are acceptable. You want gender parity, we want gender parity too. You want poverty reduction, we want poverty reduction too. So this is to say, that's the reverse side. And sometimes we tend to think there isn't enough of this. In the IMF, for example, you know, the IMF comes to a country and pushes the country, you know, as firefighters, when situation is very terrible, when there's not enough money to pay for everything. And, you know, they put money on the table against an adjustment. Now, what does that mean? You know, they say they push the country to adjust as much as politically possible. The rest goes in debt reduction to external creditors. But how much is politically possible? It's not very well defined, right? So now some civil society groups in the West say, well, there is some minimum standards in terms of not hurting the poor, in you know, keeping important expenditure on health and education. You cannot take a pint of blood just like that. You know, there's some limited liability, and they're right. And you know, the civil society in the West has to work harder to oblige the international system to adapt to being more right-based. And so you see, even IMF money comes with string attached, and this is just the reverse side of the fact that it's international institutions, and we do want to hold them to some standards.
So thank you very much. We won't take any more questions, but thank you for this great and so rich discussion about this priority topic that will certainly be at the center of the international agenda in the next weeks, in the next month. So there will be a written version of the takeaways from this discussion published in Le Grand Continent. So if you want to keep up and follow up about that, don't hesitate to keep thinking about it. And so thank you very much to you, and thank you for your attention.